Well, it's a great question. I think it's helpful to start with defining what we understand under specialty finance or asset-based lending. So we at Värde view this sector as investing and lending against granular pools of assets, usually financial receivables from consumers or small businesses. Now, this market is in the trillions, particularly if you consider all the assets sitting on bank balance sheets today. So I think what's really driving the growth is both the absolute growth of the receivables base, but also the transition of those assets out of banks into private credit hands. And there's a few key drivers there. There's certainly the external driver of regulation and accounting, but perhaps more importantly, there are inherent operating inefficiencies in banks that make these particularly small balance loans better served in the non-bank sector. And I think this transition is really turbocharging the growth we're seeing in the market. And in terms of returns, I think you're right to reference a difficult macro backdrop. We're very focused on downside protection at this stage. And there's a bunch of nuances on what you can look at, but I think the most obvious one is obviously attachment points on the asset. We'd like to be close to the asset. So where you attach is very important. And then we tend to have two layers of protection. In addition to the asset, we'll have some credit support, explicit or implicit, from an originating platform. So understanding that credit strength is paramount as well. But if we delve into some of the more nuances, we do like to understand the fundamental attractiveness of the underlying assets. And we use statistical techniques to understand base case unit economics, loss rates. We assume some loss even in the base case, but we really try to think about how bad those losses can get, which in turn will drive what we push for in terms of attachment point and covenants. I think it's one of the last remaining truly private markets in the investing space broadly. We tend to source a lot of our transactions directly, and they're often the result of long-standing relationships between the deal team and the originating platform. So having an experienced team is absolutely key in terms of driving the sourcing and deal acquisition, and also understanding the transactions and the nuances of some of these operating businesses. It's worth keeping in mind that we tend to have very detailed and in-depth covenant sets, including restrictions on operating decisions, such as, we may have a veto right on changes to the servicing policy. So there needs to be a higher level of trust here than in a broadly syndicated corporate loan, because the platform is relying on us to enable them to keep running their business. So all of that just requires long-standing experience in the space. In addition, we've been in the space for 30 plus years. We have a lot of historical data that gives us an advantage in terms of understanding likely stress scenarios. And we've owned platforms, we understand the operating intricacies of these businesses, and we've invested in NPLs, so we know what a workout scenario could look like, and we've planned for that from day one. Well, I think asset-backed lending provides valuable diversification to a cash flow heavy portfolio. In fact, we think about diversification even at the deal level. So we usually lend on very diversified pools, and we'll have covenants that encourage and require granularity within the pool. And even beyond that, we look for vintage diversification. So often, what looks like the same credit performs very differently depending on when it was originated, both as a function of the macro backdrop, as well as the continuously shifting underwriting standards in the market. So all of that, I think, provide diversification at the deal level, which is then further diversified across deals. And it's certainly orthogonal to some of the exposure you see in the corporate credit cash flow lending markets. One kind of word of caution, we do see a lot of asset-based lending or nominally asset-based lending that really is very close to corporate lending. So it's worth kind of checking that what you're getting actually attaches to the assets, has control of the assets, and really does capture that downside protection. Diversification obviously is a key advantage. We really think you can generate some very attractive risk-adjusted returns in this space. One additional point to differentiate between the two asset classes is that our assets tend to be cash flowing and self-liquidating. So we're not reliant on some sort of exit multiple to refinance us. In fact, we're cash flowing over time, which particularly in a stress scenario when you need to work out, you can be very valuable, because really if the deal is set up properly, there's nothing you need to do beyond letting the cash flows materialize and run off. So some of the things you need to pre-plan for is, any servicing or payment interruption due to a servicer transition, kind of wiring that up front, making sure your intercreditor terms are such that you don't run into any liquidation events, but you can naturally benefit from the cash flow nature of the asset.